All right, welcome everyone to day 6 of the Master Trading course. So today we're going to go over the intraday trading strategies that I'm using every single day to generate profits. So yesterday we were talking about some of the patterns that I look for, and when I first started teaching this course, we talked a lot about the patterns, and something that I wanted to build on was how the patterns by themselves aren't really a trading strategy. They're just part of a setup. So the actual strategies, require a little bit more, depth than just, okay, this is the pattern we trade. We need to know the time of the day that we trade it, our percentage of success, and that sort of thing. All right, so we'll get started with this. If you have questions as we're going, feel free to write them down and email them to me later for folks watching the recast. And folks watching this live, you can type out the questions in chat as we go and I'll answer them. Okay, so the first strategy that I want to talk about is the gap and go strategy. Okay, so this for me is where I make the majority of my profits. Okay, I trade gappers. So when I'm trading gappers, I'm going to apply the same patterns that we talked about yesterday, the bull flags, the flat top breakouts. But the gap and go strategy, for me, it's a trading strategy. I look for big percentage gains right out of the gates. Okay, so when I'm looking for a gap and go, what am I looking for? Okay, I'm looking for the stocks pre-market that have the biggest percentage gap and the highest pre-market volume. That's what I need for a good gapper. Okay, so that's a good gap candidate. Needs to be gapping up at least 4%, and I prefer at least 100,000 shares of pre-market volume. Okay, this strategy really is very simple. If we don't have any gappers, then we're not going to be trading this strategy. Today, for instance, we didn't have any really good gappers. There were a couple that were okay, but none that were really exactly what we were looking for, and so we didn't have any good trades for the gap and go strategy, and that's okay. We're not going to have them every day. They are, this strategy in some ways is a little seasonal, where when we're in earnings season, we're going to have a lot more gappers. And sometimes we just get into a more volatile market where stocks are gapping up more, and other times it's a little bit less. So this strategy might work really, really well for a few weeks, and that slows down. During the slowdown, we'll trade one of the other strategies a little bit more. Okay, so the checklist for the gap and go strategy: scan for all gappers more than 4%. Okay, so the first thing I do is I look for the movers, and then I hunt for the catalyst for the gap. Why is this gapping up, right? Why is there a lot of pre-market volume? What's the news? So it could be earnings, right? It could be a PR. There could be some FDA approval if it's a pharmaceutical drug, clinical trials. I just want to know what the catalyst is. Now, we talked about fundamental analysis a little bit last week, and this is an area where I'm not necessarily going to try to break apart the catalyst and understand all the details of it, but just knowing that there is a catalyst in play driving the stock higher, for me, is really important. Now, there are some catalysts that are going to be better than others. An activist investor taking a stake. When we find out something like that in the middle of the day, a stock will often surge up very quickly. It's basically a news play. But when it happens overnight, the stock may gap up, but it doesn't always squeeze right at the open. And that could be partly because activist investors a lot of times are taking stakes in larger cap companies, not the small cap low float. So I prefer to have a lower float watch list. So one of the things that's I don't think it's on this checklist, but you want to check the float. All right, so the float, the number of shares outstanding available to trade. We're going to check the float, and I'm going to look for under 100 million shares, but I would even prefer under 30 million. A low float means these stocks potentially can make huge moves. Okay, so when I've got a stock mapped out on my watch list, what's the information that I'm going to have? I'm going to know how much it gapped up. I'm going to know the pre-market volume. I'm going to know the float. And I'm going to know the pre-market high and the pre-market low. Okay, so the pre-market high for a gapper, I'm going to use that as the area of resistance, and I'm usually going to buy when that pre-market high breaks. Okay, so the break of the pre-market high is what I'm going to be looking at as my trigger to buy. So that means on these charts, when the market opens at 9:30, I'm going to be still looking at all the pre-market price action. Okay, so I have pre-market data turned on. That's really important because there are charts and patterns that form pre-market, and that can be the basis for our trade at 9:31. Right? I've had days like yesterday where I take a trade at 9:33, 9:34, I'm out in 3 minutes with $1,100 profit. So if I didn't have my pre-market data turned on, I wouldn't be able to take that trade because I wouldn't have seen the flag that was already forming, right? Now here's the thing. That stock, it pops up, makes a quick move up right out of the gates based on a break of a pre-market flag. So we get a profit on it. And then traders that don't have pre-market data turned on, they're just going to see that stock quickly spike up, pull back, and they're going to buy the first pullback. So when they're buying the first pullback, we're already in the profit zone. So if we want to go ahead and add more shares, either add back because we sold the whole thing or double our size, we can get even heavier, but we're already in the profit zone. So that's why I like to get in right at the open and then also buy the first pullback. Okay, so right at 9:30, I've got my orders prepared in the level 2. So the way my platform works, I can prepare the order. I can type in the share size, the price, the route, all that stuff. And all I have to do is press enter, okay? Or click the buy button. So I'll prepare these orders. I'll have 4 to 6 level 2 windows open, and these orders will all be ready. So my top 3 or 4 gappers, I'm already going to have orders ready to go. And when the market opens, 2 of them might start selling off. They're not going to be in play right away, and the other 2 might start going. I'll watch the volume. Whichever one has more volume and there's more people interested in it, that's the one I'm going to jump in. Okay, so now when we're doing gap and go trading, what we'll sometimes have happen is the gap and go red to green. Okay, so red to green, this is a sub-strategy of the gap and go strategy. And red to green by itself is a strategy that traders use, but when we apply it to gappers in the gap and go strategy, it's even stronger. Okay, so what is a red to green move? A red to green move is when a stock goes from being red on the day to green. So it breaks over the open price, the price it opened at. It opens, trades below that, and then when it comes up and surges through the open, a lot of times it's a very powerful move. Anyone that decides to short the stock right at the open is going to cover as soon as it goes green. And traders that want to be in this on the long side are going to wait for it to go green to jump in. So you have that combination of shorts covering and longs jumping in right at that red to green moment. And so that's when you can get a very quick move. All right, so the red to green move on a gapper can be a really good entry if we're not able to buy, say for instance, the pre-market flag break. Right? You know, if the pre-market flag, if it dips down right at the open, then, you know, obviously we weren't able to buy it. So the next setup is going to be the red to green move. Okay, so it's very common to see a stock that gaps up, sells off for a few candles, and then surges through the open. We'll see that pattern a lot. Okay, so here's Juno doing a red to green move. So we have a gap up, a little bit of downward consolidation here pre-market. The pre-market price action is a little bit gray here. The market opens and we go red. We sell off for 1 candle, 2 candles, and then boom, red to green move. Okay, and you can see the volume. There's some buyers that start to get in low, and then the volume just picks up and really starts to squeeze when we get up high. Okay. So, and this was a recent IPO with a great daily chart. So we had the confirmation that this was a big gapper and it had a really clean daily chart for a breakout. So that adds a little bit more power to the setup. And as I've talked about, if we don't have a great daily chart but we have a good catalyst, then we'll just go with the catalyst. But in this case, we have both. So that's even better. All right, so my Gap and Go watch list. So I get all my Gap ideas from the Trade Ideas scanner. Okay, so those are the Gap scanners. Everyone that's in the course has access to those scanners that I've written. Ideally, a stock gapping up between 5 and 10%. That's what I'm looking for. 30%, 40%, if it's a small cap stock that's having a big day, going from $3 gapping up to $5 or $6, I'll consider those. There's not a point where it's too high. We don't know. Stock could run from being gapping up 100% to 200%, and we've seen it happen, right? On the other hand, we've seen stocks gap up 10% and then sell off the whole day. So we just have to follow the price action. Just because it looks extended doesn't mean it can't keep going. All right, so one of the important things is that when we're looking at the pre-market gap, I want to see the price action consolidating in the top 20% of the range, top 30%. It has to be in the top half. If a stock gaps up from, let's say, $50 to $100, retraces to $75, that's the 50% mark. If it comes back into $60, to me, that's just too weak. So I don't like to see that kind of sell-off because since the pre-market high in that example was $100, where do we buy it? We can't wait till it goes back up to 100 because we're super chasing it. So it can be really hard to manage risk on that type of setup, and there's not really a very clear place where we should be buyers. So a stock, for me, that's ideal, it's going to gap up and then consolidate in the top 20% of the range. And what is that pattern? Quick move up, sideways consolidation, it's flagging, a pre-market flag. So then as soon as the market opens, we're going to buy that flag break. So this is what my scanner looks like in the mornings. I've got this sorted by percentage of gap. So we've got live, job, MTW, a few others here. So 15%, 12%, 10%. So that's how big of a gap we're looking at. And then here we've got the pre-market volume. So on the one hand, on a day like this, we've only got less than 15 gappers. So I can just look and see, okay, Juno, Live, and MTW, those are the three with the most pre-market volume, right? I don't need to go and resort this by highest volume. I just can see it right here. On a day where this is all green, we've got 30 gappers, I'll look at the biggest percentage gainers, and then I'll also check for the most pre-market volume, because there are times where we'll have a stock gapping up 60% on 10,000 shares, while the stock gapping up 20% on 1 million shares is actually the one we want to be trading. So even though it's only 20% compared to some of the bigger gaps, it has more volume, and we really want to follow the volume. Now, all of the stocks that are gapping up, there are days where we may not, well, today's a good example where we didn't really have an ideal setup out of the gates. So I said, okay, guys, we don't have a great gapper that I want to trade right at 931. So instead, we know our gap list. Let's watch the gappers to see which one gets volume the quickest. Let's see who's surging with volume right out of the gates. Okay, so then by sorting these gappers right here, by the ones that have the heaviest volume right at the open, we can immediately figure out which one's in play. And sometimes it's an under the radar gapper. Didn't have a lot of volume pre-market, but as soon as the market opened, volume pours into it. Other times it's very predictable which one's going to have the heavy volume, and we don't need to take that extra step. So that's just on days where the gaps are not as great. Okay, so with the gap and go, we always want to choose the best stocks, right? This is another area where we can manage risk, okay? So I select the stocks. I first look at the size of the gap, the catalyst causing the gap, and also how familiar I am with the stock. Okay, so if this is a name that I'm familiar with, or I know it's a former runner, a stock that in the past has put in really big moves, I'm going to be more attracted to it. So stocks like DGLY, Lake, LAKE, JRJC, what are some others? KNDI, Halo, TKMR, Stocks that in the past have put in really big days, when I see that they're gapping up, I'm going to look first to those because not only do I know they put in big days, all the other retail traders know it as well. So everyone sees that, oh, JRJC is gapping up today, we're going to hit this stock. Right? We know this one has the potential to fly when it has big volume. So even though, Bed Bath & Beyond might be gapping up with more volume and a bigger gap, because it's not a quote unquote hot stock, it may not get the attention. So this is another area where the longer you've been in the market, the easier it is to recognize that, okay, I'm familiar with the stock, I know the name, I know the sector, I know the story, and I know it's a big mover. Of course, everyone that's in our chat room, you have the advantage of me just giving you that information, right? Because I'll be familiar with it. So in either case, what we want to do is choose the best stock. So if I'm totally unfamiliar with a stock, I'm almost always going to be a little more cautious. Some stocks trade with a lot of spread. They're very choppy, and other stocks are very clean and easy to trade. So until we know the personality of the stock, it's better to go a little lighter. If I'm going to take a 10,000 share position, I want to feel confident that this stock is not going to tank 40 cents in my face, right? Now, if I already know the stock, then I'll feel good about that. But something like DGLY, I know that stock has the potential to drop 40 cents. So I already know its personality and I have to be a little more cautious. Okay, so that's something to make sure you don't forget about when you're doing your pre-market analysis. Okay, and then always mark out the pre-market high, and sometimes there'll be pre-market consolidation. So say a stock gaps up to $100, pulls back to 75, and then is consolidating under, let's say, $90. So we can recognize in that example the pre-market high is $100. That's the level that's really interesting, but we are consolidating under $90. So the traders are respecting $90 as an area of resistance. So when $90 breaks, we could take a position there with a first target of seeing $100, right? We get up to 100. If it's still going strong, we can hold our position, maybe add, and we have a good average. Okay, so I'll look at areas of consolidation pre-market, even if they are, well below the pre-market high. Okay, so in terms of how to trade these, right at 9:30, I have my orders ready to go. They're already written up. All I have to do is press enter, okay? Or click the buy button, depending on which order type I'm using. So a lot of times my gap and go strategy, these trades are going to be as short as 1 to 3 minutes and as long as maybe 15 to 20 minutes if it's very, very strong. What I typically do is I jump in and then get out, and then jump back in and then get out. And I get in on all of the breaks to new high, and I get out when I first have profit and I want to start scaling out, and secondly, when I start to see some sellers come in. So the gap and go for me is over 70% successful, but it's because I take profits quickly. Okay, so that's really important. You take profits when you have them. That's what works for me. So if I'm up 20 cents, I'm going to start taking a little bit of profit. Sometimes we've had trades that gap up, we'll be up 25, 30 cents. They go back down to break even, we stop out, and then they drop 30, 40 cents. So, a decent winner can turn into a big loser if we're not able to move out quickly. And on the other hand, we've had stocks that gap up and then run, 5 points. So we've seen both sides. We just have to be ready for whatever the market's going to give us. Now, there are times when a stock will, and we'll use the same example, gap up to $100. It pulls back, and even though $100, is the high a day, that's where we'd like to buy it. Say it pulls back to $85, and it doesn't have that level of consolidation at 90. It's just kind of pulling back. Well, as soon as the market opens, what do? Right? Do we wait for it to hit $100 before we buy it? Because that's the pre-market high. That's the place where we expect to see a squeeze, but that would be really chasing it. So instead what I do is I wait for the first 1 minute candle to close. Okay, so the market opens, we get that first 1 minute candle, and I mark out the high of that 1 minute candle and the low of that 1 minute candle. So that 1 minute candle is called a 1 minute opening range. Okay, so that 1 minute opening range, when we break that 1 minute opening range to the top side, I will buy it. So when we make a new high, a 1 minute candle that makes a new high, I'll buy and have my stop at the low of that 1 minute candle. Okay, so I buy the top of the range and my stop is at the low of the range. And again, if I'm up 20 cents on that trade, I'll start selling a little bit and adjust my stop to break even. Try to get myself in the driver's seat as quickly as possible. So the 1 minute opening range breakout, again, like the red to green move, this is just a strategy that can be traded, but we're going to apply it to the gap and go stocks because we know those are the stocks that have the biggest potential to run right out of the gates, right? You could apply the 1 minute opening range break to any stock you wanted, but these are the stocks that I think it works best on. Okay, so 1 minute opening range break, realistically, it's only going to work from 9:30 to, usually, 9:35, 9:40. And the entire gap and go strategy for me, by 10 a.m., it's over. Okay, so the first half hour of the day, it's where I generate almost all my profits every single day. Midday trading for me is usually a little bit slower. Afternoon trading is usually a little bit slower as well. Depending on how my morning was, I may be aggressive with the midday and the afternoon and generate more profits, or I may sit tight and go easy and not risk giving back the money I made in the first half hour, which for me is when it's easiest to generate profits. Okay, I'm most consistent in that first half hour of the day. So knowing that about myself, because today wasn't a great day, I knew, well, when's the next best chance for me to have a big winner? When's the next best chance for me to make $1,000? It's tomorrow morning. It's not going to be at 2:30 in the afternoon. It's not going to be at 3:30 right before the bell. It's going to be tomorrow morning. I know that because I know the statistics of my trading strategies. It's just a matter of fact, right? And that's important to know because then when you're thinking about being super aggressive midday, all you have to do is remind yourself, hey, what are the odds that I'm going to have a big winner at this time of day, right? And if they're only about 20%, then those odds aren't very good. You should probably wait until tomorrow morning, right? That would be the better time to take that big, heavy trade. Okay, so this right here, this is an example of a 1 minute opening range break. So this stock gap and go, gaps up. Now we can see we're well off the highs. The pre-market high was $17 and we pulled back here all the way to $12.97. Okay, so how do we really trade this? I mean, this is a really big pullback, 5 points. I mean, that really is pulled back quite a bit, down to 12 and then back up to $12.97. Okay, so as soon as the market opened, I bought this at $13 because I saw that 13 right here was a small area of resistance. Okay, so I thought, look, a break over 13, we could get a quick pop. Guess what? We got that quick pop and I sold it. Okay, I sold the whole thing. It pops up to 1446 and then it pulls back. So we have two things happening right here. On the one hand, we have a very small bull flag, pop up and 2 candles of pullback, right? And the second thing we're going to have is the 1 minute opening range. And the 1 minute opening range is from 1297 to 1446. That 1 minute candle set the opening range, the 1 minute opening range. Now, some opening range traders are going to use the 10 minute, the 15 minute, or even the 30 minute time frames. But for this strategy, I'm using the 1 minute because of how volatile the market is right at the open. Okay, so on this one, there are 2 ways you can trade it. One, you can buy the first 1 minute candle that makes a new high, which is what I did. I bought on this green candle here with my stop at the low of the previous candle. So my stop was at the doji right here, and I bought as this green candle made a new high. Second strategy, okay, that would be buying the bull flag. The second strategy is to buy the 1 minute opening range break, or the flat top breakout, or the breakout to new highs. Okay, and that would have been buying at 1446. Okay, so for me down here, buying at 1350 was buying $1 off the highs. So once we were up to 1446, I was able to add more shares with a great average. Now, a stock that was consolidating here right in this area and didn't have this cup shape, didn't have this U shape, you wouldn't need to buy it on the pullback because there's not much of a pullback. But when you have a bigger pullback the way you do in this case, sometimes it does make sense to take a partial position down low and set your stop at the low of the pullback. Okay, so you've got the 1 minute opening range break right here. That breaks out, squeezes all the way to $17. So there are traders that were able to make money on this first 1 minute candle like me because we were up early and had the pre-market charts and we did our homework. Other traders, they missed that first move, so they get in the first pullback, right? So the breakout and then the first pullback. By the time we're buying this first pullback, we're already green on the day. We already have a cushion on the name. So we're totally in the driver's seat. Say I'm up, $400 or $500 on this trade. Now, if I want to risk 1,000 on this trade, I'm already up 500 on the name. So I can be even more aggressive on the first pullback, which statistically is going to get bought up with a lot of volume, especially on a big gapping stock like this. And that's exactly what happened. Get heavy, we get the breakout, and this becomes a big winning trade. All right, and so look at this, $9.45, this thing goes from $13 to $17. I mean, you can't complain about that kind of move. It's huge. When else in the day do you have big moves like this? Right? You have them at the open. Occasionally you have them on a stock squeezing into the close. And occasionally you have them midday on a stock that picks up momentum because there's some breaking news or there's some type of technical breakout. Okay, but the most common time of the day to see this type of big price action is the first half hour. So that's when we're the most aggressive. Does that make sense to everyone? So, right, and in terms of adding to the winners, not the losers, in this particular case, we already have a profit on the name, so now we're going to be aggressive. If I lost on the first trade, I have to be even more cautious on the second trade because now I'm red, right? I don't have the cushion. Once I have that cushion, then I can start being aggressive. Say I made 1,000 on this first trade, and I want to risk, let's just say I want to risk 1,000 on the second trade. Worst case scenario, I lose the 1,000, I go back to 0 on the day, and you call it a day. You made nothing, you lost nothing, but you had a free stab risking $1,000 using a 2-to-1 profit loss ratio. If you're going to risk 1,000, it's to make 2,000. So you're risking 1,000 here with the potential to make $2,000. And say you made that 2,000, right? You're already up 1,000. Now you made another 2,000. You're up $3,000 on the day. Okay, so that's how we can turn a really nice gapper into a home run trade. It's just getting on base with that first trade, and then once we've got a little bit of a cushion, taking a swing. Sometimes we're going to stop out, break even, and we're going to give back, the profit from the first trade. But for me, it's almost always worth the stab to go in for the second trade more aggressively than the first trade. Right? Now, I say the first and second trade, but really it's the first pullback that gets bought up. Now the second pullback here, this is the second pullback, it's a little bit choppier, right? It's not as clean. So if you miss the first pullback, getting in on the second one up here is going to be riskier. So you really just want to take the first, right? The second, if it's a really clean pattern. If the second pullback is as clean as this one looks, big surge up, 3 candles pulling back, first candle to make a new high, okay, we can recognize that that's a clean pattern. But when we see this type of topping tail, this doji up here at the top, a little bit of sell-off, a pop-up, it's a little bit more iffy. Okay, especially when we make that kind of parabolic squeeze. Buying the top of that type of squeeze is really high risk. Okay, so here's another stock, NDRM. Out of the gates, we've got, what do we have here? Popped up to 880 and consolidating. So you should see this chart and know exactly where I'm a buyer. I'm buying this at 880 for the pre-market flag break, the breakout to new highs. I buy this at 880, it spikes up to 1096. Okay, look at that move, up to 1096. That is a huge move, right? And that's over the course of 45 minutes. These are 15-minute candles. But this is the type of big price action that we see in the middle of the day. That we see in the morning. All right, now on this one, we pop up to $11. We pull back here, consolidate, right? And on this one, we saw, look, what do we have here? This is a flag. We've got a flag formation on this stock. Yes, it's forming at noontime, but this is a momentum stock with a lot of volume, a lot of interest, so it's going to get bought up, 8 out of 10 times. Break of $11 squeezes up to $11.97. Okay, and then it flags there for a minute, breaks $12, squeezes up to 14, consolidates for another couple minutes, breaks up to 16.73, consolidates again, breaks up to 19.10. So when we start getting stocks that are squeezing like this, they're stair-stepping. Okay, step up, sideways, step up, sideways. And every one of those steps, we wait to buy it up. And by this time on these trades, we already have a cushion on the day because I took my first trade right here out of the gates. Okay, so this gave me the cushion on the day. That way I felt good about taking a second stab here. Win on that one. Now I feel good about a third stab, a fourth, and a fifth. Now today, for example, we had a big running stock. I can't remember the ticker name. It was PHMD. Okay, and I didn't trade this one today because I didn't make a profit on it right out of the gates. I missed it. I was watching other stocks. Okay, so by the time I noticed it, it was kind of in, it was in like this range. And I felt like, look, I don't have a cushion on the name, and the smart buyers are probably already out of this. So buying it here, I'm chasing it way up. That's much higher risk. Okay, so this type of setup here, to answer your question about short squeezes. Now, a short squeeze, essentially, it's a stock that just starts climbing up and doesn't pull back. And they call it a short squeeze because anyone that's short is just going to get squeezed. They're going to get destroyed, and they're going to have to cover. And at a certain point, if they get a margin call, their broker will try to cover the position for them, right, to reduce the broker's exposure. So sometimes you're going to have brokers just marketing in to cover up positions for their clients that have these margin calls. So when a stock runs up 100, 200%, that's when we're talking about a real squeeze. A stock that has squeeze potential is going to be a low float stock. You can do some research to see what ratio of short interest there is. The ratio would be how many shares are held short to the total outstanding float. And you can do a little research on that to get a feel for stocks that would be a better short squeeze candidate. But really, I don't look for short squeeze candidates in particular. I just look at stocks that have the good catalyst, the good gapper, and the low float, and I know that when they get going, they can be pretty crazy. And anyone that's shorting a low float stock, is really taking a gamble. So, this stock, it got pretty parabolic, right? It ran up 200%. This had a huge gap up from, like $4 to $4.50 to $9, and then ran from $9 up to $18, $19. So by all definition, this would be considered a short squeeze, right? And it took place over the course of the entire day. So it may not be, one candle that just rips everyone to pieces. It's just slow and steady, and they don't turn back. Okay, so this was an amazing gapper. This was a perfect gap and go trade. If they could be like that every day, we'd be doing ridiculously well. But they're not always that good. Here's an example on live. So we had a pre-market gap up to 414. Looks like about 410, 414. We pull back here, consolidate under $4. Okay, so a little bit of consolidation here. And what is $4? The whole dollar level of resistance, right? So we're consolidating under $4. As soon as the market opens, we buy this for the $4 break. We break that resistance, we pop up 10 cents, we take our profit, right? Maybe it's 10, 15, 20 cents, whatever it is. We take our profit, start scaling out of half. It comes back down, we got to stop out. Okay, but now what do we have? Potential for a red to green move right here for the second move over $4. So that's, first of all, we've got a potential red to green move. Secondly, over the highs of 420 right here, we have a potential 1 minute opening range breakout. Okay, so if we buy it at 4, we can even add at 420. All right, and we have a small bull flag. So we have a few setups right tied up all into this one, this one pattern. We've got the red to green, opening range breakout on the 1 minute, and we've got a bull flag. Okay, so that type of setup can be very strong because you have traders that trade those 3 different strategies all looking at this chart. Okay, and we got the nice red to green move. We got the nice resolution here. It wasn't a huge winner, but it was decent. Okay, this is Gilead, pre-market high of 96.15. It looks like we popped up right before the market opened. Market opens, we pull back and then surge up, make a quick move from 96.50 thereabouts, 96.50 up to 97.31. So a pretty quick and clean opening range breakout, gap and go strategy. Okay, and look at the big volume right at the open. If you look at almost any chart, you'll see at the open, and the first 3 or 4 candles are going to have the most volume of the day. For 80% of the charts, the most volume will be in the first 10-15 minutes. So to answer your question, once I buy the high of day at the open, what I add on the dip to the next high. So let's go back to this chart here on live. So say I buy here at $4. Would I add more on this pullback? The answer is yes, but I will have almost always sold half on the first spike because I have to take profit. Okay, so on this particular one, I may have sold everything because I sold half on the spike and stopped out break even on the rest. So I might have been all out of it and then come back in for a second trade. Okay, so that's going to depend on how far it pulls back on that first pullback. In the ideal scenario, it's going to pop up so much on that first move that when it does pull back, it won't even stop me out. So if it doesn't stop me out, then I'll hold half, and then when it does make that move up on the second pullback, I'll double back up. Does that make sense? So yeah, I definitely want to add to the winners as much as I can, but I also try to scale out aggressively because it's very frustrating for me to be up 20, 30 cents and then end up having it come back to a flat trade. Yeah, I would say around the 20-cent mark is when I'm typically going to take profit on the first spike. I would love to get 20 cents off every gap and go trade. A lot of times I take between 4 and 8,000 shares, depending on the price range. Not obviously on a $100 stock where my risk is a lot higher, but on the stock price of $20 and under, I like to take 5 to 10,000 shares. So in any of those trades, 20 cents is, anywhere from 600 to $1,000. I'm going to start taking some of that profit and, cashing it in. So 20 cents for me is usually a good target on the first pop. If they squeeze up 40 cents, I don't cap my winners. I don't have an automatic sell order. I'll just, once I see it, popping up, and once I see that I'm in the profit, I'll start throwing out a couple orders to piece out. So usually if let's say I have 4,000 shares, I might throw out an order to sell 1,000. Okay, once that sells, I might put out an order to sell 500 or maybe another 1,000. Right, I'll just start piecing out slowly. So I don't throw it all out there at once. I just start throwing out orders, see if they start getting filled, and if they do, then I'm going to feel confident. If I put out orders and nothing happens, then I might say, well, there's no buyers picking up my orders. Maybe I should sell a little bit of this just at market price or on the bid, just to lock in the profit because it seems like people aren't buying me on the offer. Okay, so with the gap and go strategy, I know my ratio and my percentages of success just by tracking it in my Excel docs. Okay, so what we talked about in the first couple of classes was making sure you track all your trades in Excel docs. That way you can look at your data later and find out what percentage of success you are on each strategy at each time of day, and that type of thing. That for me is really important because it builds that confidence that, okay, look, statistically, you're trading at 70% on the gap and go strategy. You can feel confident every day putting money into it. Right? Whereas if you have a strategy that you look at, you run the stats and you're only, 50% successful, you're going to say, I'm not doing that well at this strategy. Maybe I should go a little easier on it. Maybe I shouldn't be as aggressive as I might want to be. So that's how I know my stats. Like I said, it's very important to track that information. It's going to make you a more confident trader. right? Because you know your stats. So if you're not already doing it, it's definitely something that you should do. Okay, so here's another gapper, NDRM. This was on. Okay, this was a close-up of that first day where we surged right out of the gates. So from 825 here, 840, whatever it was, we spike up right at the open to 885, $9. We pull back a little bit, and then we can get in on that first pullback for a move back up. Okay, so the first trade right here out of the gates, this gives us the cushion. The pullback, that's the first pullback, so that's where we want to buy it up. Okay. So we've talked about the gap and go strategy. Now, opening range breakouts, this is a variation of the gap and go strategy. An opening range breakout, it's going to be a stock that between the first 10 minutes and 20 minutes of the day breaks out to new highs. So I'm going to focus primarily on the stocks that were gapping up, but as a secondary strategy, I'm going to focus on stocks that were under the radar and just had very strong volume in the first 15 minutes. Okay, so what we'll do is we'll mark out the high of the high for the first 15 minutes. That's the opening range. And then when we come back up to break that high, we want to buy it up, buy that high a day break, and we call that the opening range break. Okay, so I'm going to apply this to stocks that are surging up or that are gappers. My first priority at this time of day is to trade the gap and go strategy. But if we don't have a good gapper, then I'm going to go and try to trade an opening range breakout on a strong stock, that was just strong out of the gates. Okay, so opening range, typically the first 15 minutes, ORB, that's an abbreviation for the opening range breakout. So we look at the high of the first 15-minute candle, and when that breaks, we buy the high. A lot of times this will get bought up and we'll get a little bit of a squeeze. Even if it's only 20, 30 cents, that for us is enough profit potential to justify the trade. Okay, so in terms of finding these candidates, we'll be looking at our surging up scanner. Okay, so the ORB setup, it's a pattern. Like bull flags or like flat tops, it's a pattern. The only thing that really differentiates it is that it only works right at the open. It's an opening range breakout. So that pattern only works from 9:30 to 9:45 and buying the break of the first 15-minute candle. So, we could do an opening range breakout, I suppose, anytime between 9:45 and maybe 10:30, a stock could be consolidating right under the opening range high, and then we would buy when it does pop up. Okay, so we've got the gap and go strategy. We've got the opening range breakout strategy. Okay, and then we've got the momentum trading strategy. Now this strategy works really well from 9:30 to 10 a.m., right? But this also works midday on strong stocks. So what is the momentum trading strategy? Well, these are going to be trades on stocks that have a ton of volume coming into them. Like I said, sometimes these will be under the radar stocks that weren't on our watch list. They weren't a gapper, but market open and they surged up with volume. They're on our surging up scanner, right? That's telling us the stocks that have the most volume right now in the market. Okay, so when I see a stock on the surging up scanner, I'll pull up the chart and then I'll start looking for a pattern. One of the patterns that we went over yesterday, I'll look for the first pullback, so that's going to be a bull flag, or possibly a flat top breakout. Okay, so I'm going to look to get in these strong stocks on the first pullback. That is momentum trading. Trading these on the second and third and fourth pullback can be very risky, so I like to take the first one, possibly the second pullback, and beyond that, I'll only keep trading it if it's strong and I already have a cushion on the name. Okay, so the momentum trading strategy, these trades can be quick, 5 minutes to 15 minutes long. Sometimes they're longer, sometimes they're faster, but generally they're pretty quick trades. I'll also apply the momentum trading strategy to a stock in the middle of the day that has breaking news. Okay, so middle of the day, news comes out on, let's say, DGLY, and it spikes up 2 points. All right, we get that big spike up. What am I going to do? I'm going to buy the first pullback because now it's a momentum stock. All right, so buying the first pullback, that pullback is going to be usually in the form of a bull flag. Sometimes, if they're really strong, it'll be a flat top consolidating right underneath the highs, and then we buy the new breakout. Okay, so the momentum trading strategy, we can trade this all day long. The only criteria is that we need momentum and we need heavy volume in order to trade it. So, if there's no volume in the market, then this momentum strategy doesn't work because there's no momentum. So there are days where we'll just sit and, we'll be, say, 1 o'clock until 4 o'clock, we could be trading the momentum strategy if something pops up, but if nothing pops up, then we won't be taking any trades. So it's important to remember that our job as day traders is to follow the volume around the market. Okay, we're always looking for where the volume is. And some days there's not a lot of volume for day trading, and other days there's a ton. But either way, we sit tight, wait for good momentum setups, and then apply the momentum trading strategy. Okay, so, bull flags, flat top breakouts, those can form on any charts regardless of volume. Those are just patterns. But when we take those patterns and make them criteria for our momentum trading strategy, we're combining what we know to be good chart patterns with a strategy where we include volume parameters, possibly time of day. We know that lunchtime is slower even if there is good volume. And that sort of thing. So that's where we create a unified strategy where we utilize the patterns, but we also add some more fundamentals that are really important. Okay, now end of day squeeze strategy. This is where we look for stocks from 3 p.m. to 4 p.m. and especially from 3:30 to 4. Stocks that are up at least 25% on the day. We're going to look for stocks that have a lower float, a float of under 100 million shares. And we're going to look for these to be potential end-of-day squeeze setups. So they're going to need to be consolidating right underneath the highs. And ideally, we're going to have a nice flag from the afternoon. So from 2 to 3 p.m., we're going to have a nice flag that starts getting bought up right around 3. And then we start getting that squeeze into the close. So that's where we can get a little bit of a short squeeze, a stock that's very strong coming into the close. Anyone that's short, they're going to want to cover it up. They're not going to want to hold this overnight. A lot of times when a stock squeezes into the close, there's a higher probability that it's going to gap up the next day. And anyone that's swing trading and is short, they're not going to want to hold through that risk. So they're going to cover it up. On the flip side, anyone that's short and has a margin call, they may be forced to buy back in at market price sometime between 3:50 and 4 p.m. So that can create an additional squeeze right at the end of the day. So with end-of-day squeezes, I always set a tight stop because the worst thing is giving back an entire day's profit at 350. So set tight stops, 10-cent stops, try to get 20 to 40 cent profit targets. So then you've got your 2-to-1, 4-to-1 profit loss ratios. I don't trade end-of-day squeezes that often. A couple times a month we'll have a good one, but it's just another strategy to add to your tool belt of strategies that you go to, especially on slower days where you're just trying to find a couple winners here and there. Okay, so this is a good example. Just a strong momentum stock. If this type of momentum was occurring at the end of the day, I would definitely consider it for an end-of-day squeeze. Okay, but this pattern right here, good momentum. We got the pullback, and then we get the break to new highs. So this would be a good chart for the momentum trading strategy. Here's another one on Zaza. This is a pullback, nice bull flag, and then a break to the upside. Where do we find the stock? On our surging up scanner. Look, not much of a gap here. Only a teeny bit of pre-market volume, but then the market opens and it shoots up, right? So this stock is a momentum stock, right? So we apply the bull flag pattern to this setup. And let me look at some of these questions here. Okay, so say I'm commenting that a strategy that's working well for you is the gappers that sell off at the open, buying that flush and looking for a pop back up and a red to green move. And that's not a bad strategy. A lot of times these gappers will sell off for a couple of candles, pull back a little bit, consolidate, and then make a move. You get the red to green move, you get those buyers that come in. By itself, a stock that's pulling in, I wouldn't buy it just blindly because we've seen gappers that will gap up 5 points and sell off the whole thing. So just because it's selling off, I wouldn't buy it. But when I start to see that shift in momentum from the sellers back to the buyers, that's when I would look to get in. And so what is a way for us to visualize the shift in momentum? So for me, I look at these candles. So we have lower candle, lower candle, lower candle. Sellers are in control. First candle to make a new high tells me that buyers are starting to regain control. So right here for me is an indicator to jump in, right? That's the same with a stock that's red on the day. You have the sell-off, the sell-off, the sell-off, first candle to make a new high. That shows you the tide is beginning to change, right? Momentum is starting to come into it, so that's the place where a lot of times I would buy this up. All right, now counter trend trading strategies. This is a technique that I use from 10 a.m. to 4 p.m. I don't usually use it before 10. What we're doing in counter trend trading is we're trading against the trend of the stock. Okay, so the strategies that we've looked at already, the gap and go, the momentum strategy, end of day squeezes, opening range breakouts, those strategies are all based on jumping in strong stocks. Right, a stock that's very strong, trying to get in on the first pullback, right? Trying to find a low risk entry to get in the stock that's squeezing. And those strategies work very, very well, and that's where I make the majority of my profits. However, when we're buying stocks that are strong, a lot of times we'll get quick spikes. We want to take profits into those spikes because they can also pull back very quickly. And a lot of times those stocks are overextended when we're buying them, which means there's a little bit of a higher level of risk. Right, so my profit loss ratio on momentum strategies is going to be lower because I take 10 cents if that's all I can get. 20 cents is good. If I get 40 or 50 cents, that's kind of rare. So I have a lower profit loss ratio on my momentum strategy, but I have a higher percentage of success because it's easier for me to identify the strong stocks. So I'm more accurate, but my wins in general are a little bit smaller. So that strategy is my go-to strategy, but counter trend trading, in contrast, I have a lower percentage of success. So I'm not right as often when I try to guess the top and short it or guess the bottom and buy it. But when I'm right, my winners are really big. So I have a better profit loss ratio on counter trend trading strategies, but a lower percentage of success. So these two strategies offset each other, but I'm more aggressive on the strategy that I'm right on more. So I'm more aggressive on my momentum strategy because just the process and the reality that I'm right more often gives me more confidence. Even though I have big winners when I'm trading counter trend trades, the fact that I can go 3 or 4 trades and have back-to-back losses, just emotionally that breaks my confidence a little bit. So I don't like to go as heavy and have repeated back-to-back losses. That for me is not something that happens as often on the momentum stocks. Okay, so when we're talking about counter trend trading, again, let's return to the thought that stocks are like a rubber band. Okay, and when they're just loose, sitting flat in your hand, that's going to be the VWAP, the volume weighted average price. That's the equilibrium, that's the equal point, that's the balance point for this stock today. Okay, and when these stocks get super stretched out, right, the more they get stretched out, the more the likelihood that at some point they're going to bounce back. They're going to snap back, sometimes with just a tremendous amount of volume and momentum. Okay, so when we're looking for these reversal trades, we're looking for stocks that are really, really extended. The reason this works is because we only trade reversals on stocks that are at extremes. So just like my momentum strategy where I look for stocks that are trending up, have tons of high relative volume, those stocks are all at extremes in their own way. Reversal candidates are at extremes in the sense that they've had 5 to 10 candles in a row, and they've made a quick move either to the upside or the downside. Okay, so in the case of top reversals, we're looking for stocks that have made a very, very sharp move up and are getting ready to top out. Now, it's worth noting that the market, in the past few years has been very strong, and so a lot of times when we get these pullbacks on stocks that we might think would be a good candidate for a top reversal, they just get bought up. So we always want to set a very tight stop when we're doing counter trend trading. One, because percentage of success is going to be a bit lower, right? So since we know we lose a little bit more often, we want to make sure those losses are small. And two, because when a stock starts to bounce and move back up, we just want to be able to get out quickly, and we're going to have more confidence taking these trades when we only have a 10 or 15 cent stop. Okay, so generally speaking, I focus more on the bottom bounces than the top reversals. Because I have more of a long bias in the market, I prefer buying to shorting, but top reversals can work well if we have the right setup. So you can check that link there on the screen share on the slideshow, and you can look at a few examples of top reversals, and we'll look at one that we actually traded today on MHFI. This was a really good top reversal. Okay, so on this one we had 2, 4, 6 green candles in a row. Okay. And what is the sixth candle? What is the candlestick pattern, or what type of candle is that? That's a doji. Okay, this is a doji. That means the open and close are at almost the same price. So we've got a little bit of an upper wick, a little bit of a lower wick, open, close are at the same price. And this candle is completely outside our Bollinger Bands. Okay, these pink bands here are the Bollinger Bands, and this candle is completely outside them. That is another exhaustion warning. That tells us this trend is getting really exhausted. It's really stretched out. Okay, so I short this with a stop at the high of day. In this case, it was about a 30-cent stop, and I started covering as it came back in. Okay, this was a very nice, smooth trade. I found this stock using our Trade Ideas strategy scanners for top reversals. Okay, so what do I look for when I'm doing a reversal trade? The most important thing, 5 to 10 green candles in a row, and I look to short dojis. I really like shorting dojis. I really like it when I can get a tight stop, and I really like it when the candle is outside the Bollinger Bands. Okay? So for bottom bounces, this is going to be the same sort of thing except in reverse. So we'll go through the bottom bounces in a little bit more detail, and just remember you can apply these to the top reversals just in reverse. Okay, so setup requirements. We look for a big extension to the downside. Think of that rubber band getting stretched out. You want to be able to visualize that this stock has made a very strong move down, and we prefer to see higher volume. We want to see that the peak of the sell-off is also peaking on volume. So what we're looking for ultimately is a V shape. Okay, and we'll go back to this example. This has a V shape. It's an upside down V, quick move up and a quick move down. And the peak of the V has very high volume. So this high volume pattern, as we're ramping up, we expect to have high volume on the first candles that sell off and then decreasing. Okay, so we're going to look for the same thing on the bottom bounces, that quick sell-off on high volume, a peak in the volume as we bounce, right? All these buyers and sellers are coming together at the bounce point. We jump in, and then we ride it on the way back up. So we're always looking for that quick V shape, and if we don't get that quick bounce, we're going to want to get out quickly. Okay, so the best bounces, they have that heavy sell-off, that peak in selling volume. I'm going to focus between 10 a.m. and 4 p.m. So basically that's the entire day, right? We can have a stock that's at an intraday extreme at 12:30, and it's going to put in a perfectly tradable bottom bounce. So this is a strategy that we can trade through the lunch hour. We can trade it in the slow afternoon, trading hours. The only thing that we do have to be careful about is what the overall market is doing. So Jen, that's a great question. Do I use the SPY to find reversal setups? And the answer is no, I don't use the SPY. But if we have a day where the market is selling off, naturally we're going to see a lot more stocks hitting our bottom bounce scanner because more stocks are hitting new lows. So it can be a little tricky to filter out all of that noise because just because the stock market is hitting new lows and there's lots of stocks on our low of day reversal scanner doesn't mean they're all good candidates for a bounce. Or say it's a particularly weak day in the oil sector and all the oil stocks are hitting new lows, they may not be bouncing. Right, there may be a catalyst for the sell-off, and this is the area where it can get a little tricky trading reversals because there are times where there is a catalyst for the sell-off, and that's going to be stronger than the technicals, which is the rubber band. So the rubber band may seem stretched out, but it can keep getting stretched even more and more and more beyond what we might think is reasonable. So we have to be careful with the reversals, and that's why the percentage of success for me is a bit lower because we may have a really great setup, but it's just not ready to bounce. Okay, so in terms of entry indicators, as I was mentioning a few minutes ago, the first thing I look for is a 1-minute candle to make a new high or a 5-minute candle to make a new high. So depending on the choppiness of the chart, I may not be able to use a 1-minute candles if the 1-minute chart is choppy. But if we have 10, 15 1-minute candles that have all made new lows and we just see red, 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 the first one that goes green and makes a new high, we know that those are going to have a higher probability of being the bottom and the point where we have a lot of buyers that come in. So whether you're using the 1-minute or the 5-minute, either way, we're looking for the first candle to make a new high. Okay, so where do you set your stop? Well, on the one hand, you can set your stop at low of day, but when low of day does hit, you will get slippage, okay, because there's other people that set their stop at the same place. So stop by default is low of day. If the stock makes new lows, we definitely have to get out. But a lot of times I'll set an arbitrary stop down, say 20 cents. So if we get a sell-off and I'm down 20 cents, then I'm just going to bail out, right? I'm down 20 cents. I'd rather just take a small loss and come back at it when it sets back up. So that's part of my philosophy of taking lots of small losses, small winners, and just always wait to be set up for that next big winner. Okay, another exit indicator, if we're in it for a few minutes and we have green candles, the first candle to make a new low is going to be our exit indicator. All right, now as we make a move back up off the bottom, we're going to see a little resistance as we run into moving averages. So the 9 moving average, the 20 moving average, the 200 moving average, and the VWAP, these can all be areas of resistance. And as we approach those different areas, it's a good idea to take a little bit of profit along the way. Okay, so with the bottom bounces, we have 2 advantages. One, we have shorts that cover, right? And the retail traders who I think are long biased, jumping in to get stocks off the bottom or possibly reduce their average of a core position that they've been holding for a long time. So bottom reversals that coincide with 5-minute, 15-minute, 30-minute charts are going to be even stronger because longer-term traders could see those bottoming kind of patterns as opportunities to reduce their average cost. Okay, so you have a combination of buyers that are going to come into this, whether it's shorts covering that we're just day trading it, retail traders that want to come in for a bounce, or investors that want to reduce their cost basis. Okay, so bounce examples, the 1-minute versus the 5-minute. So here we've got a nice 5-minute bottom bounce on TWC, Time Warner Cable. Okay, nice sell-off. 1, 2, 3, 4, 5, 6 red candles. First candle to make a new high right here. It's off a doji. Doji on the bottom. We buy the top of this candle. Sure, we could set our stop at the low of the doji, or we could just say, I'm going to get in this with a 20-cent stop. It either goes or it doesn't, and in this case, it went. Okay, so we get a pop up to our moving averages. Here on HCA, we get a quick sell-off. There was some news that came out on this midday, so 12:45. We get a quick sell-off from $68 down to $65. Down here, the first 1-minute candle to make a new high over $65.55. Buyers come in, we get that peak in volume at the bottom. Buyers come in, and it bounces right back up. Another bounce example here, RATE, sell off. We've got 3, 6, 9, 10, 11 red candles. Doji at the bottom, first candle to make the new high, that's where we buy it. Get in around 1091, and we sell on the move up to 1150. So even on a lower price range, we can still get really nice bottom bounces. Okay, and remember, this pattern, this is the same thing we would look at for a top reversal, right? We would look for, 10, 12 green candles, doji at the top, and short that doji. Stop can be at the low of day, or it can be 10, 20 cents away, depending on the price range. CRUS, sell off, selling, selling, selling. First 1 minute candle to make a new high, and we get a pop. Okay, this one's not quite as clean because we're on the 1 minute chart. Right, so it's a little bit choppier here. 1 minute charts are a little bit riskier. You'll see the cleaner setups are on the 5 minute. Here's another one on the 1 minute. We sell, we put in a little bounce. We sell, bounce, sell, bounce, sell, bounce, sell, bounce, sell, bounce, sell, bounce. So then we all of a sudden here we actually start to reverse. Well, by this time you already tried it once, twice, 3, 4, 5, 6 times. So this is why instead of using the 1 minute, which can be a lot choppier, I'd prefer to use the 5 minute chart. Okay, unless we have a clean 1 minute, and clean means we don't have this choppy, we just have steady sell off. Otherwise, I'm going to focus on the 5 minute. Okay, so and to answer your question about higher beta stocks, so a stock with a higher beta is going to be more reactive to the market. So if the overall market drops, 10 points, a higher beta stock is going to drop 20 points. Or 30 points. So it's going to have even more reactivity to the market. So percentage-wise, and it's not points, it's just the percentage of volatility. So on the one hand, a higher beta stock, if the market starts bouncing, yeah, that'd be great. We'll jump in a higher beta stock. We're going to get a nice bounce with the market, and these stocks are going to bounce even higher. On the other hand, a higher beta stock is going to be more reactive to the overall market. So if we put in a false bottom on the market, 5-10 minute bounce and then start selling off sharply again, it's going to start selling off as well. So this is again the area where it can be a little bit frustrating trying to time reversals when we feel like they're very connected to the overall market or a particular sector. So one of the things that I find easier is to focus on stocks that have a very clear sell-off like this. This is very, very clear. Okay, so this is, you can't argue that this is a nice sell-off, right? It's just, it is. It is what it is. Everyone can see it. So as soon as we start to bounce, there's a very clear line in the sand where people are going to come in. Something like this. These are very clear. And this was on a news trade, midday news, so that's even better. This was in the morning, so that was a strong one. Now we can get strong stocks midday, but generally speaking, all we really need is the high volume. So whether it's the morning or the afternoon, we just need that volume to confirm and that clean sell-off, that 5 to 10 red candle stretch. That's what we look for. So, this one here on CRUS, really not as clean, right? And same thing on NFX here, really not as clean. And maybe the 5 minute looked better, but this 1 minute was really too choppy. So if there's any question in your mind, does this look like a clean setup? Then the answer is probably no, right? It should be fairly obvious that this is a clean setup. Since we know the percentage of success is lower on reversal trades, we have to make sure we're taking the best setups, because even the best setups will still fake us out, right? So we don't want to take low quality setups. All right, so anyone watching the recording that has questions, feel free to email me, ross@daytradewarrior.com, and we'll pick up with the next class tomorrow morning.